a special edition of SB Talks, where we go under the bonnet of the Stanford Brown Investment Committee to discuss our recent Strategic Asset Allocation review. Now, no better person to do that with than our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
So, Nick, where I'd like to start is actually to discuss the role that asset allocation plays in a portfolio. You know, most investors would say, just give me as much of the highest returning investment possible. Isn't that really the approach to investing?
Well, if we knew what the highest returning investment possible is, but we don't have perfect foresight, unfortunately. So we have to blend different asset classes. And as I've said at various times in the past, diversification is the only real free lunch in portfolio construction. Finding assets that zig when others zag allows you to produce smoother returns and better overall returns as well.
So elaborate on that a little further if you can. So what are you ideally looking for when you are thinking about blending assets in a portfolio?
I'm looking for things that don't all move together. So there might be different underlying variables that drive the returns. For example, cash and bonds don't necessarily behave the same way that equities do. So when you blend them in a portfolio, you get smoother returns without necessarily sacrificing returns.
Yeah. So ultimately, you're aiming for a scenario where you still getting as high a return as you can, but with a smoother journey along the way.
That's right. You know, as they say, sometimes worrying about the losses, and then the returns will take care of themselves. So managing the downside so that you don't have those big drops, and the returns will hopefully, be good over the long term.
Yeah. Particularly if you're drawing on your capital through the journey. So that's important to set the scene for the review that we've undertaken, and you've sort of touched on a couple of things that you'll elaborate more as we proceed through the discussion. But I'd also like, if you can, set out for the listeners the difference between perhaps a strategic asset allocation and its role for an investment committee versus a tactical asset allocation.
So when many of our clients come in, they talk to us about their objectives, and they might be to achieve a certain return over a certain time horizon, and they might have a certain risk tolerance. And so our advice team work with that client to often trade off some of those things, and we arrive at a kind of, a strategic asset allocation that hopefully meets those objectives. So strategic asset allocation is, in broad terms, the long-term average weights to different asset classes through the business cycle. So that could be through a recession, if one happens next year or the year after, and through a boom. So basically,
it's almost like your default starting point, all else being equal.
That's right. It's the average weighting to equities, bonds, cash, and other asset classes across a business cycle. And then that's the strategic asset allocation. And then we try and trim that, dial it up or dial it down, depending on how we're seeing things. We've spoken a bit about this in the past. So dynamic asset allocation tends to have a shorter term time horizon, maybe 3 to 12 months. And we'll tweak the asset allocation weights over that period to try and either capture returns or reduce risk in the portfolio.
Protecting downside on the way through. So how do you go about that process when you're evaluating what that long-term strategic asset allocation should be? What's the journey that you go through in coming to the outcome?
So a lot of it is based on maths. It's based on capital markets assumptions. So we try and come up with, either ourselves or in this case, we've worked with our asset consultant, Jana, come up with capital market forecasts. So what do we think equities will earn over that long-term time horizon? What will bonds earn? What will the return on cash be? And how much risk is involved with each asset class? So they also forecast risk.
Now define risk for the listener.
Well, risk is generally the volatility of returns, so the swings around the average. So they forecast the average return, and then they also might forecast how wildly there might be variations around those average returns. Two
corresponding assets might return 6%, but one of them might get there by returning anywhere between -6 and 12, and one of them might return somewhere between 4.5 and 7.5. You'd probably prefer the one with the less variation in returns.
That's right. That's lower volatility. Of course, there are other ways of measuring risk. Some people say, well, that measure only that captures upside risk as well as downside risk. I'm really only concerned with the downside. So there are other risk measures that only look at the downside risk, and we look at those as well. So we take those capital market forecasts and we put them into an optimization software, and that spits out the ideal portfolio that provides the highest possible returns with each level of risk that we're looking at.
So that optimization software is really trying to say, okay, well, how do I get to a return outcome with as little risk as possible to get to that outcome?
You can do it that way, or you can do it the other way and say, what's the best return I can get for this level of risk?
Yeah. And there you go, job's done, right?
Well, no, that's the science part, and then there's the art that comes into it. So often these optimizers are quite naive, and they'll often put it into one or two asset classes, whereas we...
Perhaps give us some examples of what an optimizer might throw out in the first instance.
Well, for example, we it loves cash, for example, at very low risk levels. But we know cash generally doesn't provide very good returns over the long term. It's often the worst performing asset class. But
certainly in real terms,
the optimizer loves it because of very low volatility. And then at the other extreme, it goes into small cap equities and emerging markets equities, the most risky because they have the highest expected return
assumptions.
And then in the middle, we get a lot of hedge funds and alternative investments because they have quite good risk-adjusted returns in that sort of middle part of the risk curve.
As in risk-adjusted returns, as in the return they're delivering relative to the volatility or the downside volatility that they. And let's deal with the elephant in the room. A lot of investors are very comfortable, particularly an Australian investor, with 2 or 3 different types of assets and portfolios, particularly Australian shares. We love Australian shares, cash term deposits as well, possibly some hybrids in the middle. What does a risk optimizer think of that type of a strategy?
It doesn't think too much of it, actually, because essentially the home country bias gets de-weighted in that portfolio, where Australian shares are competing with international shares and with a lot of other asset classes, they don't actually score that well. And so when we ran our optimizer using Jana's assumptions, it actually didn't put much in Australian bonds or Australian shares. And if you think about it intuitively, that's probably not that surprising. Australian bonds are less than 2% of the global bond market, and Australian shares are a similar sort of number as a share of the global financial market. So 98% of the best opportunities potentially lie offshore. So it doesn't necessarily make sense for an Australian portfolio to have such a high weight as they often do. So the other thing that the optimizer likes is it likes things like currency risk. Currency is a great shock absorber. The Australian dollar is pro-cyclical. It often falls when people perceive that growth is slowing or equity markets are falling or there's issues in China, as we're seeing at the moment. And so that's another source of diversification that the optimizer likes.
So it's not so much that the optimizer likes risk, it just likes how, as an Australian investor, the Australian dollar typically moves when markets are declining. Often, say global share markets are declining, it's usually at the time that risk is less popular, therefore the Australian dollar is obviously usually declining in that scenario, and therefore cushions a portfolio.
Yeah, it's another source of diversification which the optimizer likes, and also to put it in context, like the Australian ASX 200, 50% of that is in the top 10 stocks. 20% in BHP and CBA. So it's not very well diversified, our market anyway. So I think that's another reason why the optimizer likes having more securities and more countries and more sectors.
So you talked a little bit about the science approach and then the art overlay of the science. The optimizer loved cash at very low levels and potentially skews to other asset classes at the higher risk. How do you then start to do the art part, the overlays? What's the process you go through there to try and get a sort of an outcome that you feel is appropriate for investors?
I think when we did the review, we were very concerned that we might be heading back into an economic scenario that looked maybe a bit more like the 1960s, 70s and 80s, where economies were more volatile, there were business cycles, they were quite short. Inflation was more volatile. Interest rates went up and down to try and, deal with that. There were oil price shocks. There were wars. And maybe the last 10 years pre-pandemic was a bit unusual. And the next 10 years might look potentially more like that period I just mentioned. And so we wanted portfolios that could be maybe a bit more resilient to inflation, a bit more diversified. And so we didn't go with what the optimizer said, which was to put it all into one or two asset classes. We wanted to spread it across 8 asset classes, or in fact 20 underlying asset classes, to have more diversification and hopefully more levers to pull on if markets maybe move sideways or inflation is more volatile. So that's where the art came into it.
And how do you, what's the process you start to go through there then when you start to look at, okay, where to draw the line in terms of how much to have in some of those portfolios? How much do you look at the correlation between them and the overall blend as well?
Yeah, it's finding that optimal balance, between what the optimizer is telling us, what we think clients would expect, what makes sense intuitively. It's all of those, and also looking at what else is out there in the market. Looking at peer funds, looking at big super funds. Let's actually touch to that. What do you see when you look out there to the market? I think there would be a traditional in the financial advice, financial planning history of Australia, where there is a big, heavy home country bias, and that prevails. What do you see when you look at more to the institutional world or things like the Future Fund? Yes, well, they actually don't have much of a home country bias. I mean, they're still overweight Aussie equities, relative to the global weights, as I mentioned, but they certainly have more invested internationally than they do in Australia, and that's the direction I guess we wanted to head in. So the Future Fund, for example, only I think has 9% in Australian shares. Right. It has about 30% in developed and emerging market shares.
And quite a bit in alternative asset classes.
That's right. And then we hear about often the endowment models in the US, the Yale and Harvard endowment, where they have 50%, for example, in hedge funds and private equity and other asset classes like that. So not much in traditional asset classes. So there's different ways of building portfolios, but it's always interesting to try and, take the best ideas and to put it into the art of creating portfolios.
So at this stage, Nick, perhaps let's cut to the chase and talk about the end result. Perhaps we'll use the traditional balanced portfolio, the 60-40, what would be known as the 60-40 portfolio. In your strategic asset allocation review, what happens to that portfolio in terms of the asset classes?
Yeah, so it'll still be a 60-40 portfolio, or in the case of our balanced, it's 65-35. So
yes.
Those ratios stay the same. I think it's what's happening under the hood. So as I mentioned, we were looking to reduce the home country bias. So we'll be dialing back the Australian equity allocation from 32 to 20%. We're keeping the global equity allocation the same at 25. So we will now have more international versus Australia. And that 12% that we're taking out of Australian shares, we're going to put another 2% in property and real assets asset class. We're creating a permanent allocation to infrastructure within there. So that asset class will be 10%, 50% infrastructure, 50% property. And then we will also be adding to growth alternatives. Now, we already have growth alternatives in our current portfolio, but it was a strategic asset allocation of 0, and that'll be moving to 10%.
Before we step into talking growth alternatives, I might quickly just touch back on property, real assets, infrastructure, and why you see they have an important role to play in portfolios.
Yeah, so property and real assets, the thing we like about them is that they generally have income streams that are fairly defensive, quite stable, often linked to inflation. So, it might be toll roads where there's a toll that's linked to CPI. It might be an airport where the airport landing charges are tied to inflation. It might be a property where the rents are indexed to CPI or market reviews. So we like that aspect to those asset classes. They are real assets. They're actually real things that exist underlying them. They're not necessarily financial assets. And often they have also, sometimes there's a commodity element to them. For example, oil and gas pipelines, may have some commodity price exposure or certainly commodity volume exposure in there. So that's also a good inflation hedge.
Inflation protection. And for those listeners that have read many of the media reports recently regarding unlisted property prices in Australia and question marks over that, and they're concerned about what that might mean, anything you want to explain in terms of how we are allocating to property?
Well, property is a very large asset class globally, and we hear about doom and gloom in the office sector, but there are plenty of other subsectors that probably are more robust. For example, there's a new sub-asset class in property called data centers, and they're actually, the big data centers that house a lot of the cloud computing resources. So that's actually a very high growth area. There's in the US, there's multifamily, which is basically apartment blocks, and there's such a huge demand for rental properties in Australia and in the US. So that's a sector that's doing quite well. So I think you can't necessarily generalize property. It often comes down to the subsectors.
Property does not mean necessarily your local Australian retail centre or office block in Sydney or Melbourne. Yeah. And actually, now that you touch about that, I think we'll come back and perhaps have a special edition of Under the Bonnet with the Investment Committee looking at probably that property, real assets and infrastructure, because when you get into things like data centers, a high debate of whether it is actually a property asset or an infrastructure asset in any way. Another conversation for another day.
Yeah, well, there's blurred lines increasingly between some of the asset classes.
Now, I might now take you back to the area of growth alternatives. Alternatives, listeners probably not as familiar with those as they would be with shares, with cash, perhaps with bonds, or certainly with real assets. And that help explain what sits inside that universe and how you think about allocating there.
Yeah, well, it's a very heterogeneous asset class. There's a lot of different strategies and sub-strategies. Essentially these are typically hedge funds by and large. There are other alternatives, growth alternatives that maybe not hedge funds. But typically, these are strategies that are trying to prosecute either take advantage of some sort of systematic inefficiency or price trends. So at the moment, we have some trend-following managers. They try and take advantage of trends in currencies, commodities, bond markets, equity markets, both up and down. And so they theoretically can make money in both rising and falling markets, so long as there are price trends. There are other strategies, equity long short. Many people will be familiar with funds that buy stocks that they think will go up and short sell stocks that they think might go down.
So they're managing their overall equity market exposure, but basically buying the ones they like and betting against the ones they don't.
That's right, and they're less dependent on the movement in the overall market. It's more magnified exposure of their actual stock picking ability.
What's the return profile you're looking for from that type of a manager when you are allocating to alternatives?
So in the growth alternative space, we're basically looking for equity-like returns and equity-like risk, but not necessarily tied into the equity markets per se. So, around that sort of 10% type return.
Okay. And any other types of manager strategies in that space?
Yeah, there's other strategies. One's called event-driven. These are funds that try and take advantage of various, often corporate events. So a corporate event might be a company listing on the stock exchange. It might be a company subject to a takeover or a merger or a liquidation, a wind-up of a company, where the share price might not reflect the fundamental value that's embedded in that transaction. So event-driven is another strategy that's quite popular. Distressed debt, that can be part of that event-driven space.
Explain that a little further for the listeners.
Often when a company gets into distress, their bonds get downgraded to junk status or default status and trade at a few cents on the dollar. And if the investor does their work, they might realize that the intrinsic value in a bankruptcy situation or wind up might be many times higher than that. So the performance of that security is less about the overall direction of markets. It's more about, whether the investor's done their homework on assessing the wind-up recovery value from that security. Another strategy is relative value as well, and that's often fixed income based, where they're trying to find related securities that often trade together, where there might be for whatever reason the prices have diverged, and they're trying to make profit from the mean reversion of those prices.
So overall, you put these strategies together and ultimately you come back to that similar story that you tell before. So you're aiming for strategies that can provide returns like at the levels of equities, but ideally with less overall gyrations in the total portfolio on the journey to get there.
Yeah, that's right. So if we do go into an environment where maybe equity markets move sideways or even down, hopefully these strategies can still deliver. On the other side of the ledger, and the defensive side, we're still 35% in defensive assets, but we're just going to change the mix slightly. So we're adding 5% into defensive alternatives. So similar types of strategies to some of the ones I just mentioned, but more bond-like returns and bond-like risk.
So they're running to a lower target risk and therefore the returns are corresponding.
That's right, more defensive in nature. And we're also changing the mix between Australian debt and global debt. We feel that there's far more opportunities globally, particularly in some sectors like high-yield bonds and high-yield loans and investment-grade credit that we don't really have much of in Australia. So that's
offering better opportunities or risk-adjusted returns for the investors stepping outside of the Australian market.
Absolutely, and just simply more diversity, just far more companies, far more sectors, and more opportunities for added value.
Any other comments there that you'd like to make in terms of the overall process and the outcome? And I guess most importantly, where to from here?
Yeah, so we've done an extensive review. We've come up with some funds that we think are good additions to the portfolio. So we'll be making changes to our balanced portfolios shortly to reflect the new strategic asset allocation. Excellent.
Well, you can expect to hear more on that from your advisors. I'll also highlight that if you received your link to this podcast via the email, you will have a paper that Nick has written around delving even deeper into that asset allocation review. Otherwise, please don't hesitate to reach out to your advisor. We can certainly share that with you. And we will share more information again in the weeks to come regarding the updates to the portfolios. But for now, thank you very much as always, Nick. And thank you to you all. Speak soon. Take care.